This is the final chapter, and this is what we building up towards. In this chapter, I will be introducing to you my favorite trading strategy that I employ in the market every single day. It is time to introduce the trading strategy which I've been talking about throughout these chapters. But before I give you the particulars of the strategy, I'd like to tell you in my own words what the ethos behind the strategy is, so you have an idea of how to trade it. I run a live trading room where people from all over the world log into my site and they watch me trade. Talk about the pressure of being on you beyond the pressure of simply trading your own account. But the reverse divergence strategy is the one that I can count on. It is the one that I use repeatedly in the live trading room. I know that when I spot one of these setups, there is a better than 70% chance that I will have a winning trade. But did you hear what I just said? I said better than 70%. That doesn't mean I will be guaranteed a winning trade. Anything can happen. So when I place a trade, I know full well that I may simply be wrong, and I have to live with that and I have to accept it. It doesn't mean that I'll have to like it. Who on earth likes to lose money? But that is the nature of the game from time to time. The coin game has taught me that there's a whole lot of randomness around, and my only job is to carry on trading and carry on playing the game over and over. When it comes to forex trading, and indeed any other kind of trading, I have a mantra which I tend to stick to consistently, and it goes like this. I want to fade the short-term trend in the direction of the long-term trend. But of course, that requires a bit of explaining. So let's go through this mantra again. What does fading mean? Fading a move means that you go against the flow. It means that you believe the current move is a temporary move against the major trend and that the real trend is in the other direction. It means that if the market is going up temporarily, but you believe the overall trend is down, you are on the lookout for selling short the market. You are essentially fading the current up move because you believe the market will shortly or immediately reassert the trend lower. The second question that needs to be answered is the definition of the short-term trend and the long-term trend. Now, my long-term trend may be someone else's short-term trend. If I'm day trading the forex market, I will define the trend on a 1-hour chart and on the 4-hour chart. But I will place my trades using a 15-minute or even a 5-minute chart. I'm often in my trades for something like 20 or 30 minutes, and I tend not to risk more than 30-40 pips on any one position. So consider this for a moment. Most human beings are perfectly rational and are fully capable of holding down jobs, professional careers, being parents, balancing their checkbooks, and behaving in a socially acceptable manner set by standard of society. So when they enter the trading arena, they expect the same kind of order, but it isn't there. In this world of mine and soon to be yours, order is wishful thinking. There's sometimes no rhyme or reason to what's going on. There's no order. There's no structure. All there is what you have trained your eyes to see in the market. I literally had to train my eyes to see order that newcomers generally don't see so readily. And that takes time and it takes practice. Practice makes perfect. But in order to help my eyes, I put up some visual aids on the charts. We have already discussed these aids at length, but we will look at them again. When I'm looking for a reverse divergence setup, I want to use the following visual aids. I use an 89 period moving average to define the trend of the time frame I am trading and the one I am looking at. It is only a visual aid, and although it is vitally important to my trading, its only function is to tell me if the trend is up or down. When I'm looking for trading setups, I'll start off by looking at the 4-hour chart. Currency markets have a remarkable propensity to trend, and I prefer not to trade against the trend set on the 4-hour chart. So if I'm looking at a 15-minute chart, the 89 period moving average may say the trend is down, while if I looked at the 4-hour chart with the same 89 period moving average, it may say that the 4-hour trend is up. So the question is, how do you solve this conflict between two time frames? And the fact of the matter is, you don't. You can't solve it. There is nothing to solve. You have to accept and embrace the fact that trading will never be perfect. If you're waiting for the perfect setup, you'll wait for a long time, and it rarely happens. When you think it's too good to be true, it probably is. I have to deal with what is right here, right now. But don't forget that while the trend on the 4-hour chart is down, there may still be some very good trading setups on the 15-minute chart that calls for you to trade against the trend of the 4-hour chart. And that is perfectly okay, as long as you know where to get out if you are wrong on the trade. The visual aid I use is the oscillator. I use the standard settings, which comes as a standard on all charting packages. The settings are 14, free, and that's it. I don't use anything else. I know so many traders who have all sorts of rubbish on their charts. It makes the screen look like a circus arena. Trust me when I say that the more junk you have on your screen, the more confused you will become. You might want to consider taking off all of the indicators and begin to simply appreciate the beauty of the pure chart. I found that by over-relying on too many indicators, my analysis gave way to paralysis. I simply was incapacitated, unable to execute any trades. I could not make up my mind until all the indicators were all lined up, and by the time they were all lined up, it was often too late to trade. It is time to get into the nitty-gritty of the reverse divergence strategy. My reverse divergence setup essentially involves buying into a market which is already trending higher, or selling short a market which is already trending lower. And I use the 89 period moving average to define the trend. What I'm looking for is as follows. My trend indicator needs to point in one direction, up or down. If the trend is indicating higher, I will be looking to buy the market. The market should be trading above the 89 period moving average as well. That's very important. If the trend indicator is pointing down, I'll be looking to sell short the market, and I want to ensure the market is trading below the 89 period moving average. So let's take a practical example, because that's really the best way that you can learn this strategy. On this chart, the market is trading below the 89 period MA. And the 89 period MA is also pointing down, so you know that we will be looking for an opportunity and a place to sell short the market. You can also see that the market has made a high and now looks set to potentially make a lower high. This is indicated by the blue line on the price chart. On the momentum indicator side of the chart, where I use the stochastics for this setup, you can see how it is making a series of rising highs. I've drawn a blue line on the momentum indicator signifying it is making a rising high. The peak on the price chart corresponds with a peak on the momentum chart. The secondary peak on the price chart, which is lower than the first peak on the price chart, signifies a downtrend, but on the momentum indicator, the corresponding peak is higher than the previous peak. And this is what's known as a reverse divergence. The red line you see in the middle of the chart image is my attempt to draw a line where the market will find resistance. There's no specific law to drawing this line, and it is largely the result of trial and error and years of trading experience. On this trade, I sold the euro-dollar short at 142.17. I then immediately placed my stop loss at 142.45, which was the high made on the news announcement, which caused the spike higher and also initially lower. My feeling at the time was that if the market could take out this level of 142.45, it would stand a good chance of running even further, and I would not want to be in the market anymore. Fortunate for me, the market backed off and eventually traded down below 142.00. At this point, I moved my stop loss from 142.45 down to my entry point at 142.17, so I knew that I couldn't lose a penny on the trade. And that's very important as a trader. Money management is what's going to keep you in this game. At this point, it was getting a little late in the day, and I moved my stop loss further down to 142.10, hoping I wouldn't get stopped out during the night trading session where I'm asleep. Unfortunately for me, I did get stopped out because when I woke up early next morning, the market was trading at 142.60. Still, I got stopped out of my trading with a small profit and with the ability to trade another day. Let's take another example, this time on the sterling dollar. With the benefit of hindsight, I love this trade because I did everything right. The sterling dollar was trading through and above the 89 period moving average on the 30-minute chart, and I was looking for a place to buy the market. The old rule of support and resistance gave me a helping hand in this trade. The horizontal black line identified areas on the chart where there had been distinct support and resistance in the past. The currency was trading above the 89 period MA, so I knew the market was bullish. Now it was a question of keeping an eye on the oscillator to get an entry signal. On the chart on the screen, you can see how the price is making a rising low while the oscillator is making a new low. What I'm particularly pleased about on this trade was that although the oscillator made a new low and price made a higher low, I did not immediately buy the market. I patiently waited for the market to hit an important area of support before I committed my working capital to the trade. As a matter of fact, I waited for almost 2 hours for the right place to buy sterling dollar. Was I tempted to jump the gun and get in on the action? Of course I was. I'm not a robot. I'm a human being and I have to keep check on myself and the 4 trading fears constantly. Trading fear number 3, if you remember, states that I'm afraid to miss the move, and of course I was afraid to let this one run away from me. Well, in this case, I may have been afraid to miss the move, but I did wait patiently and I was filled on the trade at 168.09. I always take a screenshot of the market at the time of my trade for future reference. It is a brilliant way to learn and to spot flaws in your analysis when you review your trades after the market is closed. My stop in this case was 40 pips, which meant that if the market traded down to 167.69, I would have been stopped out. When you trade the reverse divergence on a 5-minute chart versus trading the same setup on, for example, an hourly chart, your expectations are going to be slightly different. You're not expecting to clock up hundreds of pips from trading the reverse divergence on a 5-minute chart. However, if you are trading it on an hourly chart or on a 4-hour chart, your expectations are going to be somewhat different. Furthermore, when you are trading it on a 5-minute chart, you may want to increase your stake size a little bit but reduce the stop loss. And if you are trading it on a 4-hour chart, you may want to use larger stop losses but reducing your stake size somewhat. My preferred time frame to trade the reverse divergence is, without doubt, the 15-minute and on the 30-minute chart. I rarely use stops of more than 40 pips. If I'm trading some of the yen crosses, such as the sterling yen, I may use a slightly larger stop, but I will then reduce my stake size to bring my money management into line with the parameters set up for my trading account. I don't want to risk much more than 1% or so on any day trade. This concludes my trading strategy. My hope here is that you will run with this strategy and make it your own. The reverse divergence strategy is perfect for building trading discipline in relation to the exercise with a 30-trade experiment. If you commit to follow this strategy through thick and thin for the next 30 trades, you will build trading discipline. You can even do it on a demo account. You will do what very few people have done, which is to commit to learn to trade properly. It is important to have a good strategy, and you have that now. What is more important is that you have trading discipline and that you can follow a trading plan. My aim here with this course was right from the beginning to equip you with both the technical and the psychological knowledge to succeed in one of the toughest jobs in the world, but also one of the most enjoyable games in the world. I hope you enjoyed it. My name is Tom Hugard, and I wish you all the trading success in the world.